Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest. Now today on the show, we're exploring the diamond market where natural diamond sales have significantly declined, partly due to the rise of lab-grown diamonds impacting the market and driving prices down. In fact, prices of the natural diamonds have dropped 5.9% this year alone. That according to the Zimnisky Global Rough Diamond Price Index. But my next guest from Diamond Standard believes that despite the current downturn, diamonds are on the verge of becoming a fully investable commodity asset class, opening new opportunities for investors around the world. Joining us to discuss this is Cormac Kinney, the founder of Diamond Standard. Cormac is a seasoned entrepreneur who has been instrumental in merging technology with finance. Cormac, welcome to Kitco News.
Great to be here with you. Thank you.
I appreciate your time today. Let's jump right into it. As I mentioned off the top, it's been a very interesting couple of years in the diamond market. Demand during COVID was up enormously, and then Russia invaded Ukraine, and that was kind of it for diamond prices. I mean, there's more to it than that, but it sounds like it's going to get even more interesting here. So why don't you start by giving our viewers a little lay of the land of the diamond market currently, Cormac?
Yeah, that's exactly right. So diamond prices are very focused on jewelry demand because that's the only use for diamonds up until now. And exactly as you mentioned, Russia supplies about 30% of the world's diamonds. And starting in early 2022, they started dumping these diamonds to raise cash. And that tanked the diamond market. Around the same time, there was also the rise of lab-grown diamonds, which consumed some of the supply, but that wasn't the real driver. And in fact, we think now that lab-grown diamonds have been kind of played out. A lot of retailers are going back to natural and consumers too. And we think because of the availability of investment products that diamond prices are about to rise significantly.
Yeah, what an opportunity. I mean, we'll get into that in a second. Let's talk a little bit more about the company. What is Diamond Standard, and how does it propose to transform diamonds into a commodity asset class?
Well, we've actually accomplished that. So the problem with diamonds is that every diamond is just a little bit different. They have the carat weight, the color, the clarity, all those different factors. And you probably know that they're nonlinear. As a diamond gets larger, like a 5-carat diamond versus a 1-carat, the price is not 5 times more, it might be 50 times more. And the same thing happens when a diamond becomes flawless or decolor. So diamonds are nonlinear, and nobody really knows what a diamond is worth. They're very subjective. And in the markets, we call that transparency and price discovery. There's no way to force price discovery until now. What Diamond Standard does is, using computer science, we created fungible diamond commodities, which look like this. These are Diamond Standard bars. And the breakthrough is that each of these bars are equivalent. They contain a group of natural diamonds that are optimized to have the same carat weight, color, and clarity. These bars, because they're all fungible, they're all equivalent, they all have the same market value on any given day. And between our two products, we make coins and bars. The coins are all smaller diamonds. The bars are larger. These coins trade today for around $4,300. The bars are $43,000. But this, for the first time, creates a fungible, tradable commodity that has unlocked diamonds as an investable asset.
Yeah, I mean, it's fascinating to me. I have a little bit of experience into this. I was engaged last year, purchased a diamond, learned a lot. There's VS1, 2, ABCDE. There's a lot of different terms here. And I mean, as you just mentioned, considering each diamond's unique traits, how does Diamond Standard manage to standardize these into a group that is a tradable commodity? How do you differentiate and make them all equal here?
Yeah, that's the breakthrough. So my background is quantitative trading. I was a portfolio manager for Paul Tudor Jones and for Millennium, where I ran quantitative equities. I also spent about 15 years building trading systems. So that was the background that was needed to create Diamond Standard. And the secret is automated market making. We have no opinions about the value of diamonds. We literally bid using on an exchange for 16 million different varieties of diamonds every day. What I mean by variety is a combination of carat weight, color, and clarity. We make a bid, and we have right now about $5 billion worth of diamonds listed on our exchange, and we have 220 members, which are all the largest diamond companies in the world. We bid on their diamonds, and the computer slowly raises these millions of prices until somebody says yes. And our job is to buy a statistically valid sample of all the different types of diamonds in the world. And then we force price discovery by bidding. And then our computer divides those diamonds fairly into these coins or bars so that every bar has the same amount of carat weight, color, and clarity. And that's what makes them the same. That whole process, by the way, is done under regulatory supervision, and our processes are audited by Deloitte.
Wow, interesting. Okay, you were talking a little bit about the technical and statistical methods, kind of ensuring that this whole standardization that you talked about doesn't overlook individual diamond qualities. Is that the case here? How do you make it so that if there's a really good quality diamond in that pack or in that bar, maybe it's offset by alternatives? How does that work?
That's right. So that process is called optimization. And you'll see all these patents behind me. We had a number of breakthroughs in nonlinear optimization and what's called integer programming. An integer, is a 1 or a 0. And either the diamond is in the coin or it isn't. You can't divide a diamond in half, for example. So in our optimization process, there are all these constraints. For example, there must be at least 8 diamonds in every coin, but there cannot be more than 9. There must be a minimum of carat weight, of color, of clarities. And most importantly, there must be a yield curve. And what I mean by that is the yield of the earth. You can imagine over the last 50 years, you can determine what frequency of diamonds are decolor, for example. That's about 3%. It's very, very few. These coins, 3% of the diamonds or of the carat weight is decolor. So we represent all of those different frequencies of diamond quality. They're always the same in every bar or coin.
Interesting. Okay, so investors purchase this bar, they purchase this coin. Can they then directly redeem their diamond token for physical diamonds? Tell me a little bit more about this process. What does that entail?
So when you buy this commodity, we are an agent for the investor. We don't own any diamonds that we sell at a markup, for example. So, and also most importantly, we don't set the price of this commodity. In the same way that Barrick Gold doesn't set the price of gold. Gold trades on the market the same way these bars trade on the market. And whatever that market price is for trading, that's the spot. And it's reported on Bloomberg and Reuters or Refinitiv and S&P. So we look at that spot market and we sell our commodities at the spot. And then our job is to buy the diamonds extremely efficiently. And we have intake offices in all the major diamond centers like India, Hong Kong, Antwerp, and Dubai. We buy the diamonds using automated market making. We pay for them immediately so we don't have to have financing. And then we package them for the investor. Once we produce the bar, which takes about 20 days, we then give the buyer a choice. We will ship this to you and deliver it in anywhere in the United States, Canada, or Europe. The problem is you have to pay sales tax, or if you join 96% of our other clients, you can take delivery in Geneva coming soon. But right now, most people take delivery in Delaware. And we built our own custody vault in Delaware in partnership with Brinks, and there's no sales tax in Delaware.
That makes sense. Okay, typically you go and sell diamond jewelry in the resale market, and it's at a discount. How's this different?
So what we've eliminated are all those retail markups. By the time you buy a diamond ring in a jewelry store, it's gone through 5 hands. The miner, the cutter, the broker, the traders, the jewelry manufacturer, and the retailer. We're buying the diamonds at the source, directly from the companies that cut the diamonds. So we've cut out all those margins, all those markups. And when you own this commodity, if it's held by Brinks in Delaware, there's a wireless computer chip in the bar that issues a blockchain token to the owner. That's a vault receipt that you can trade and sell, and whoever owns that vault receipt, they own the bar. So once you have this commodity, you can sell it 24 hours a day on a spot market, and there's actually no fees for that trading.
Interesting. Okay, what happens if there's a significant demand for physical redemption? How would you handle such a scenario without affecting the token's market value here?
There's exactly one token per bar. So you own this particular bar. You can see its serial number on here. There's no question about, and we don't custody it. It's held by a trust in your name. So you can take delivery any day a week, and Brinks sends it to you, not us. So there's no possibility of there ever not being a bar that a customer owns. It's in their name. It's titled to them.
A lot of gold bugs love the fact that you can go buy a gold bar, take it to your garage, you can hide it. Maybe you don't know if you own it. You emphasize talking about security and privacy, obviously things that you take very seriously. Elaborate on the specific measures that the company implements to safeguard investor assets and personal data. I know you mentioned there that you're working with Brinks.
So Brinks is one of our custodial partners. We also have a regulatory license. So we're overseen by the Bermuda Monetary Authority. And people say, why'd you go to Bermuda? Well, the CFTC and the SEC, they can't regulate physical commodities. We had to find a regulator that would oversee the entire process leading up to the token issuance. That's the law that we complied with. But the key is when you buy this commodity, it's delivered. It's either delivered to you in your hands at your home, or it's delivered to the custodian in your name. So there's never a question of us holding assets for anybody. They're always held in the investor's name, and you can take delivery. Even if you bought the token, you might be the third or fourth owner. The bar stays in Brinks, and then you return that token, and Brinks sends the commodity to the final owner. By the way, some people ask, what if I want the actual diamonds?
Yeah.
All you do is take delivery of the bar, and we designed this that you drop it in paint thinner, but you can get it at any hardware store, and the bar melts. And you can now have 8 GIA certified diamonds that you can put into a necklace.
Oh, it's quite the interesting stuff there, Cormac. Okay, recently Kitco News was on location at Consensus. Diamond Standard was one of the sponsors for that coverage. So many exciting things happening in the decentralized world. Which blockchain platform is utilized for trading these tokens, and why did you choose it?
So actually, what's a huge breakthrough is that because the token is locked to the computer chip, you can actually, this bar is compatible with any blockchain. So right now we have it on Avalanche, Ethereum, Hedera, and we're adding more blockchains over time. But the reason we were at Consensus is we announced a major breakthrough, which is that if you own this bar, instead of just trading the entire token or the entire bar, you can tell your bar to issue a currency, which is called carats. Carats are a commodity currency. It comes out of a tangible asset, being this bar. And you can use carats the same way you use Bitcoin, except it has a real asset behind it, but you can use it for payments. But what's interesting about carats is that they're legally not considered what's called a virtual currency. They're legally a commodity, which means platforms that use carats do not have to collect everyone's driver's license when they're just spending $50. You're allowed to transfer commodity titles without the same low level of KYC and AML that you have with other crypto like Tether, Bitcoin, ETH, or really anything else.
Wow. Okay. So, I mean, you're creating liquidity for a market that hasn't really had it before. How do you establish spot price for diamonds when there's so many characteristics that are so diverse then in the trading?
Yeah, I call it the Adam Smith process, the invisible hand. And it's literally brute force. We have no algorithms. no estimates. We literally make 16 million bids. There's not 16 million diamonds. There's about 2 million diamonds listed on our exchange on any given day. But we bid for every possible diamond in the hope that a vendor will see the price and list a diamond. Our goal, of course, is to buy them as efficiently as possible to benefit our investors. But that's the first time in history that there's been a market maker forcing price discovery for every different type of diamond. And our job is to buy a statistical sample that we can prove represents every different type of diamond characteristic.
Okay, let's talk about lab-grown diamonds. I mean, they took off. We can't deny that, likely because they were a cheaper option. They're identical to natural diamonds on a molecular level, but how have lab-grown diamonds impacted the market for natural diamonds, especially in terms of investment and pricing here?
I think they had a significant short-term impact, and it's very much like a Picasso painting, right? If someone makes a perfect replica of a Picasso, of course you want to have that in your home, but that doesn't make the original less valuable. And if you can make infinite copies of that Picasso, the copies become worthless. The original is still very valuable. And I think it was one of the most effective marketing campaigns in history, the lab-grown diamonds, where they bragged that they're good for the earth and they're collecting carbon from the atmosphere. All of that was greenwashing. Lab-grown diamonds are made in China and India, and they're burning coal and wood. And what I don't like about them, they're beautiful, and they're a substitute for cubic zirconia, much more beautiful. But lab-grown diamonds don't create any jobs, and there's no economic substance. So if you compare that to a diamond mine, there are thousands of people that work for a diamond mine, capital expenditures, they pay the taxes, they support the economy. Lab-grown diamonds, one person can manage 300 machines. So what you've seen in the last week, De Beers has announced they're out of the lab-grown diamond business. They really got into it to drive the price down, so they were very, very successful. A number of large lab-grown diamond manufacturers have gone bankrupt, and the prices at wholesale of lab-grown diamonds are down about 90%. What you'll see, though, in the retail stores is that the retailers mark up lab-grown diamonds. I've seen 50x markups because they can buy a 1-carat diamond for $280, and they're trying to sell it for $2,800. So we think that consumers are starting to realize that, and the retailers are now starting to come back. They can't make the revenue. They might make a big profit margin on a small cost, but they don't make the same revenue from selling a lab-grown diamond that they can make with a natural diamond. So they have to decide, I have that customer walking in my store, do I want to make $1,000 or $2,000? And so many of them are coming back to natural. We think diamonds are at low.
It almost sounds like it's more of a long-term play here. I mean, you don't see that lab-grown diamonds as a potential risk to the valuation of the natural market here in terms of investment?
Ultimately, no, because only natural diamonds are useful for an investment. And I think by far the biggest story is what happens to natural diamond prices now that there's an investment market, now that they're being financialized. Lab-grown diamonds, the big myth is that you cannot tell the difference. They're starting to put equipment in retail stores where you can walk in, show it, put your ring in, and it'll tell you instantly that's a lab-grown diamond. It's not real versus a natural diamond. What we're seeing with natural diamonds is that the earth is running out. Every single mine that's open today has an expected lifetime, and more than half of them are fully depleted in the next 11 years. All of them are empty by in about 40 years. So natural diamonds are running out, and only, as De Beers used to say, only real is rare. So only natural diamonds have an investment potential.
So we're at kind of the bottom of the market here. I know that Diamond Standard has been busy with the upcoming launch of an exchange and an ETF. How do you foresee these innovations affecting the liquidity and the value of diamonds as an investment here?
So if you look at every precious metal, and we have a chart that we can share, investors own at least 15% of platinum, palladium, even rhodium. Even more, like silver and gold, investors own 20 to 30%. Investors only own 2% of diamonds. So as investment products come out, and so far we have approval for futures and options in the United States. We recently got approval for an ETF. As these investment products come out, we expect that investors will acquire 15% of diamonds in the same way they own 15% of precious metals. And this is not the first time that a natural resource has been financialized.
Okay, let's talk a little bit about the ethical sourcing of diamonds. I mean, we've all watched the movie Blood Diamond. We know what the narrative has been around about diamonds. And typically, we've seen also on the marketing side a lot of narrative about lab-grown diamonds being, a better option to this. Talk to me about if those exist in the market and what's the case here, for concerns around things like blood diamonds and then the environmental impact of the extraction.
So yeah, I mean, if you really peel the onion into the ethics, you'll learn that the rumors are not true. Mm-hmm. The blood diamonds were referring to Sierra Leone and the Civil War, which was in the 90s. And in response, the United Nations created the Kimberley process. Every diamond that has been in America for the last 40 years has a Kimberley certificate, meaning that it traces what mine it came from. So blood diamonds have not been an issue since the late 90s. So that's one big myth that we want to correct. There's also the myth that De Beers controls the market. They really don't. They produce about 28% of diamonds, and they don't even own the mines. The mines are owned by countries like Botswana that force them to sell whatever they dig up. But the real thing about ethics is I believe in creating jobs, creating economic substance. And you look at Botswana as a great example, as a country in Africa, that standard of living has gone up 400% in the last 15 years because they've been able to tap into the benefits, the finances of creating diamonds, the jobs and the education that came from that. You don't have any of that with lab-grown diamonds. You have a machine printing them out by the hundreds.
Okay. Now, there's some people that say, okay, there's only one person working in that lab creating diamonds, but then there's a little bit of talk about the cheap labor markets and the exploding child labor, those types of things within the traditional. Let's just hone in on that a minute. You're saying that what we kind of have been told about this whole man-made market within labs, more smoke than fire here. A lot of it was more of a marketing campaign?
Oh, absolutely. It's greenwashing. So I heard some of these companies talk about how they're taking carbon from the air and compressing that into a diamond. It's simply not true. Those lab-grown diamonds use tremendous amounts of power. It's a high temperature, high heat, and that creates these. But most importantly, there's just no jobs. It does not create jobs. It's a unlimited printing of diamonds, and the value shows they've gone down 90%. It's because there's no economic constraints to making them.
Interesting. I want you to educate the audience a little bit here. I mean, considering the principles of Sharia law, you're unable to lend and add interest. Talk to me about how diamonds fit as an investment here and what compliance measures you need to implement in order to align with the principles.
That was one of the biggest surprises of my entire career. And, we built this commodity to unlock diamonds as an investment. It was only after several trips to Saudi Arabia where I met with some of the banks, some of the Islamic mullahs, they're called, the priests, and I learned about Sharia law. You're not allowed to lend money and charge interest. So what the banks do is they literally lend the borrower a commodity. And it used to be things like nickel or steel or copper. Today it's overwhelmingly palm oil. And they cannot lend gold or silver, because those are both in the Quran as money. So right now, a bank will lend someone palm oil, like 100,000 gallons, and that palm oil is somewhere in Malaysia. The problem with that is, according to the Quran, you're supposed to be able to take possession. There's no way for a borrower to take possession of palm oil. And so the religious authorities are saying this is a farce. Our commodity turns out, it's not gold or silver, and it's extremely small and deliverable. And the electronic title that comes out of the token itself complies with Sharia law. So we have a number of banks that are beginning to do a pilot to use diamond commodities to asset-back commodity murabaha, which is the term for these Sharia-compliant loans. That industry, by the way, of Sharia finance is $4.5 trillion per year and is expected to grow to $6.5 trillion by 2027. So we believe that that's an example of an entirely new demand for diamonds. And that's the real story here, is what is the new demand for diamonds from investments, from Sharia law, and from digital? That's what impact is that going to have on diamond prices?
And you're working with Saudi Arabia on this, correct? In terms of an exchange, what's the timeline here? What are you thinking?
We think this year. So we already have an exchange based in Delaware. Our plan is to move that to Riyadh, Saudi Arabia. And what's important is we're not allowing any leverage or any interest. That's why all the palm oil is traded in Malaysia, because it's an Islamic exchange. Turns out because our exchange is spot and has no leverage, it was actually a very easy transition. So we're working with the Vision 2030 program in Saudi Arabia, where they're interested to attract a lot more commodity trading. And we also plan to start doing our assembly for Middle Eastern delivery. We're going to do in Saudi Arabia as well.
Fascinating. What an interesting time. Okay, how do you correlate traditional safe haven assets like gold? I mean, I've been reporting on gold all-time highs throughout the year. I mean, central banks picking up more and more, even though a couple of countries pausing. Talk to me about how these two relate here and what your expectations are once it's liquid asset.
Yeah, well, I like to go back in time a little bit. And if you look in from 1990 to 2002, gold fell about 15%. It was flat. It went nowhere. And then in 2002, something happened. It was the first gold ETF. And if you look at today, gold ETFs hold about $200 billion worth of gold. And most importantly, they made it easily accessible to institutional investors, sovereign wealth funds, endowments, etc. They can all buy gold without the hassle of holding bars. That began a 530% rise in the price of gold after being flat for almost 20 years. Gold shot up 500%. And that continues today. The same exact scenario happened with silver in 2005. The first silver ETF precipitated a 320% rise in silver. The most recent example is uranium, where the Sprott ETF, Sprott Physical Uranium ETF launched in Canada about 2.5 years ago. And today that has 6.6 billion of uranium. That fund alone drove uranium up almost 200% in a little over 2 years. We believe that diamonds now are going to go through that same demand cycle as they're financialized with futures, options, and ETF. And that might bring it up to 15%, which is the same as platinum, for example. But unlike platinum, diamonds also have demand from Sharia finance and as a digital asset. I think because of all of that demand coming in a period of 3 to 6 years, I predict diamond prices go up 10x.
Interesting. Okay, well then can you compare the investment performance and stability of diamonds directly against gold, especially with what we've been dealing with in the economic situation, you know, interest rates and what have you? How's the resilience in compared to here?
Well, long term, diamonds were never accessible to investors. So their fluctuation was entirely based on the ebb and flow of demand for jewelry. And jewelry is mostly correlated to the stock market, by the way. Mm-hmm. So if the stock market is up, jewelry sales are up and diamond prices are up. Today, that's kind of broken down because of COVID. And historically, diamonds are back to their same low price as 20 years ago, which I think is the all-time low. Diamonds did not have zero correlation to gold. They have a lot less volatility as well. So the only period where diamonds historically outperformed gold was in the early phases of COVID, when diamonds ran up about 40%. And at the same time, gold was relatively flat. But recently, diamonds, because of the Ukraine, because of the slow economy in China, diamonds have fallen about 40%. So they're right back where they started. But we think that's the calm before the storm.
Fascinating. So fascinating. So I guess what you're saying is buy the dip. Before I let you go, give me your investment thesis for the year and 2025 with these approvals that you're talking about.
Yeah. So I think right now is a unique opportunity for individual investors because firms like BlackRock, they own $9 trillion worth of assets. They buy literally everything that's liquid. And think of all the natural resource funds that own every different type of mine, every type of battery metal. And they could never invest in diamond, which is, as I said, $1 trillion asset. The point is, as soon as the ETF is live, all of those funds will start to build a position. And that's going to drive diamond demand for, I think, a 3 to 5 year phase. But right now, while diamonds are at their all-time low, is when a consumer or private individual or a hedge fund can start to build a position before the institutions have the opportunity. They're not going to buy bars or coins. They're going to wait for the ETF. So I believe now, while diamonds are at their all-time low, is the time to start building a position. It's the contrarian thesis.
I like it. Fascinating stuff. Cormac Kinney, the founder of Diamond Standard, joining us from New York. Fascinating stuff. I could have talked to you for hours here, Cormac. Thanks for joining us today. I appreciate your time.
Thank you for having me. See you. We'll catch up again soon.
I hope so. Yeah. Best of luck with those approvals, and we'll be in touch soon. Thanks again. Diamond Standard was our sponsor of coverage for Consensus 2024. Be sure to check out that playlist for coverage at the show and to learn more about these new technologies at play in our financial world. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. Don't forget to subscribe. More great content coming your way. We'll see you soon.